What's your first take?
Well, it doesn't move the needle really for the Fed, but it does give them permission if they want to go 50 to be more dovish in the sense that it doesn't look like inflation's a problem. At least inflation expectations are a problem in the short run, 2.7%. They go up in the 5 to 10 year, they go up to 3.1 from 3.0, but that's way out there at this point. And the Fed isn't going to think that is any kind of realistic change that they have to worry about. Current conditions rise to 62.9 from 61.3, which is a fairly good increase, and expectations up to 73 from 72.1. So this is probably the best Michigan numbers we've seen in a little bit of time. It's too early probably to know whether the debate had any impact on that because it was just before the end of the survey. We'd only had a couple days to pick that up. But people do seem a bit happier about the overall economy, which gives the Fed the idea also that maybe they don't need to move because the economy's in good shape.
Two-year yields are lower on the back of this report as well, and I still am a little bit confused here because if the consumer believes that inflation is going to be around 2.7%, they're feeling pretty good, in fact better than expected, why cut 50 basis points?
Well, that's the question. The Fed has to decide that they think the economy is in worse shape and needs a quick jolt to do anything, to maintain. The problem is at this point, it's not going to matter a whole lot because it takes a while to get into the economy, so it's not going to have an effect on the election or the way people think in the short run about the economy. So the Fed has to look out and try to figure out what's the economy going to be like in the early part of next year when this might start getting into the overall economy. And that's kind of the question. And as you know, there are a lot of different views on Wall Street about that.